There are investors who spend their entire careers chasing the next hot stock, jumping from one idea to another, absorbing every financial report, attending every industry conference, and yet somehow, decade after decade, they never manage to build the kind of lasting wealth that truly changes lives and changes families and changes futures. Then there is Charlie Munger, a man who made billions of dollars not by working harder than everyone else, not by having access to secret information, and not by using complicated trading systems that required supercomputers and armies of analysts, but simply by thinking better than almost everyone else alive. If you want to understand what separates the truly great investors from all the rest, if you want to know why some people seem to see opportunities that are invisible to everyone around them, if you want to know how one man built a mind that was so powerful, so clear, and so consistently right across so many different fields and situations, then you need to understand Charlie Munger, his mind, his philosophy, his habits, and his way of seeing the world in a way that almost no one else could match. Charlie Munger spent most of his life as the business partner of Warren Buffett at Berkshire Hathaway, and together, they built one of the greatest investment records in the entire history of financial markets. But Munger was not just a sidekick, not just a supporting player in someone else's story. He was a titan in his own right, with a depth of thinking and a range of knowledge that made him genuinely unique in the world of business and finance. Before joining forces with Buffett on a permanent basis, he had already built a highly successful investment partnership on his own, producing returns that far outpaced the broader market over a sustained period. He came from a background in law, not finance. He had no formal training in investing. What he had was something far more valuable than any finance degree or Wall Street training program could provide, and that was an insatiable curiosity about the world, a deep and genuine commitment to lifelong learning across every field he could get his hands on, and a set of mental tools that had been built up and refined over decades of study, experience, and deep reflection, tools that allowed him to cut through complexity and arrive at clear, correct answers faster and more reliably than almost anyone else. The book by David Clark, which brings together the most powerful thoughts, quotes, and ideas from Charlie Munger and explains them in plain, direct language, is a genuine treasure chest for anyone who is serious about investing and about making better decisions in every part of their life. What you are about to absorb is the essence of that wisdom, drawn together from across Munger's long life and extraordinary career, expanded upon with the context needed to truly understand why these ideas work, and delivered in a way that any investor, anywhere in the world, at any level of experience, can understand and immediately begin to apply. The ideas in this tradition of thinking are not complicated in the way that advanced mathematics is complicated. They are not inaccessible in the way that highly technical scientific research is inaccessible. They are, in many cases, genuinely simple. But they are simple in the way that truth is simple, which means most people overlook them, underestimate them, or dismiss them as obvious without ever truly understanding them or putting them to work. Munger himself often said that the best ideas are the ones that seem obvious in hindsight, but are rarely acted upon with any consistency. His goal throughout his career was to collect these powerful ideas, to build a mental toolkit from them, and to use them consistently and deliberately across every domain of life. He wanted to be someone who could think correctly more often than anyone around him, and he built himself into exactly that person through decades of dedicated, disciplined learning. So let us begin at the very beginning, with the man himself, with where he came from, with how he developed his extraordinary way of thinking, and with why his particular approach to knowledge and decision-making is so different and so much more powerful than the way most people are taught to think about money, about business, and about success. Charlie Munger was born on January 1st, 1924, in Omaha, Nebraska. Yes, the same city where Warren Buffett was born, a remarkable coincidence that would eventually lead to one of the most extraordinary partnerships in the history of business. He grew up in a middle-class family, and showed from a very early age a love of books and ideas that set him apart from most of his peers. His grandfather was a federal judge, and this family environment gave Munger a deep respect from childhood for logic, for evidence, for the careful examination of arguments before reaching conclusions, and for the profound importance of being honest and rigorous in your thinking. He was, from the very beginning, someone who loved to figure out how things worked, not just machines or physical systems, but people, institutions, organizations, ideas, and the complex interactions between all of these things. He attended the University of Michigan briefly before being called into service during the Second World War, which was one of those great disruptions of the 20th century that shaped the careers and the thinking of an entire generation. During his time in the military, he studied meteorology at the California Institute of Technology, one of the world's great scientific institutions, and this gave him early exposure to rigorous scientific thinking, to the kind of careful, systematic reasoning that distinguished good science from wishful thinking. After the war, he applied to Harvard Law School and was admitted even without an undergraduate degree, which was a testament to the quality of his mind and his preparation. He graduated with distinction and went on to practice law in California, where he built a highly successful legal career. But even as he practiced law and developed a strong reputation in that field, Munger was becoming increasingly fascinated by business and by investing. He began to invest his own capital, and he found that his legal training, which had taught him to evaluate complex situations, weigh competing arguments, identify the key facts that mattered, and reach defensible conclusions, combined powerfully with his natural curiosity and his deep habit of learning across many fields, giving him enormous advantages when it came to evaluating businesses and their long-term prospects. He was not just looking at the numbers on a balance sheet or in a profit and loss statement. He was looking at the business as a whole system, at the industry it operated in, at the people running it, at the competitive dynamics that would shape its future, at the customer psychology that drove demand for its products, and at the long-term trends that would either support or undermine its position. This holistic, systems-level view of business was deeply unusual in the investing world of that era, and it gave him a perspective that most other investors simply did not have. In 1962, Munger founded his own investment partnership, and over the following decade or so, this partnership produced extraordinary returns for the investors who trusted him with their capital, significantly outperforming the broader stock market over a sustained and meaningful period. He achieved this not through diversification or through constant trading or through following the conventional wisdom of the day, but through concentrated, long-term investing in high-quality businesses at reasonable prices. This approach was already fundamentally different from the way most investors at that time, and even today, operated. Most investors spread their bets across dozens or even hundreds of positions. Most investors trade frequently, responding to every piece of new information and every movement in stock prices. Most investors focus heavily on the next quarter or the next year. Munger did the opposite. He concentrated his capital in a small number of situations he understood deeply. He held for long periods, letting the underlying business create value over time. And he focused relentlessly on the underlying economics and competitive position of the business, not on the daily or weekly price of the stock. In the early 1970s, Munger began to work more closely with Warren Buffett, whom he had met years earlier through a mutual acquaintance. The two men had an instant intellectual rapport that went far beyond their shared love of business and investing. Both were extraordinarily voracious learners, men who consumed books and ideas across many fields with genuine hunger. Both loved business at a deep, almost visceral level. Both thought carefully and seriously about the nature of competitive advantage, about what made one business genuinely better than another as a long-term investment, and about the long-term economics of different kinds of industries and business models. But Munger brought something to the partnership that took even Buffett's already extraordinary thinking to a significantly higher level. He brought the perspective of multiple disciplines, the conviction that you simply could not understand a business or an investment or any complex situation by applying only economic or financial thinking. You needed to bring in psychology, which tells you how people actually behave as opposed to how economic theory predicts they will behave. You needed to bring in history, which tells you what has actually happened in situations that seemed similar to the one you are analyzing now. You needed to bring in mathematics, which gives you tools for thinking about probability and statistics and the range of possible outcomes. You needed to bring in biology, which offers powerful frameworks for thinking about evolution, adaptation, competition, and the selection of the fittest in any competitive environment. You needed to bring in physics, which provides mental models like critical mass, leverage, and equilibrium that apply far beyond the physical world. And you needed to bring in many other fields besides. You needed, in short, to see the full picture, not just the financial slice of it. And this idea, this profound commitment to thinking across many disciplines at once, is perhaps the single most important concept in the entire body of Munger's wisdom. He called the resulting framework the latticework of mental models, and it is where we must start if we want to truly understand how he thought and how you can begin to think in a similar way. Think of your mind as a kind of structure, a building of knowledge and thinking tools. Most people, as they grow up and go through school and begin their careers, add to that building based almost entirely on whatever their particular job or profession requires. An accountant fills the building with accounting concepts and financial analysis tools. A lawyer fills it with legal frameworks and argumentation strategies. An engineer fills it with technical knowledge specific to their domain. And while these discipline-specific tools are genuinely useful within their domains, they leave enormous gaps in the person's ability to understand the full range of situations they will encounter. They leave the person blind to insights that are perfectly obvious to someone coming from a different field. They leave the person vulnerable to making mistakes that someone with a broader perspective would never make, because they lack the mental tools to even see the danger. Munger's solution was to build a latticework, a framework constructed not from the tools of any single discipline, but from the most important and most broadly applicable ideas drawn from all the major fields of human knowledge. He argued that if you truly understood the most powerful ideas from physics, from biology, from mathematics, from psychology, from economics, from history, from philosophy, and from several other disciplines, and if you could connect these ideas into a coherent, integrated framework in your mind, you would be able to understand almost any situation more clearly, identify more of the relevant factors, and make better decisions than someone who only knew one or two disciplines, no matter how deeply they knew those particular fields. He called these most powerful ideas mental models. A mental model is simply a way of understanding how something works, a framework for thinking about a particular type of situation. Every major discipline has a relatively small number of core ideas that explain a very large proportion of what happens within that domain. Think of them as the master keys that unlock the most important doors. If you learn these core ideas deeply and thoroughly, and if you learn to apply them outside their original domain, seeing where they illuminate situations that superficially seem very different from where the idea originated, you gain an enormous power as a thinker. Let us go through some of the most important mental models that Munger identified and used throughout his investing career and his life. The first, and perhaps most fundamental, is the concept of inversion. Munger borrowed this idea from the great German mathematician Carl Jacobi, who famously said that you must always invert. The idea is beautifully simple, but enormously powerful. When you are trying to solve a problem or achieve a goal, instead of only asking how you can achieve that goal, also ask what would cause you to fail to achieve that goal, and then work systematically to avoid those failure modes. Instead of asking what could make this investment succeed, ask what could make this investment fail spectacularly. Instead of asking how to build a great business, Ask what the most common causes of business failure are, and then make sure your business avoids every single one of them. Munger applied this inversion principle constantly and across every domain of his thinking. When he was evaluating whether to invest in a business, he would not just ask what the positive case looked like. He would ask what were the most likely ways this investment could turn into a disaster. What were the risks that were easy to overlook when you were excited about the opportunity? What were the assumptions built into the investment thesis that, if proven wrong, would cause a terrible outcome? By asking these questions systematically and rigorously, he avoided many of the mistakes that other investors made because they were so focused on the upside that they never gave serious attention to the downside. Inversion also works beautifully at a higher level of thinking about life and success. Munger once said, with characteristic directness, that if you want to be happy, first figure out all the things that make people miserable, and then systematically avoid those things. If you want a successful business, first figure out all the things that cause businesses to fail, and then make absolutely sure your business does not do any of those things. If you want to be a great investor, first figure out all the ways that investors destroy their wealth, and then build a system that prevents you from doing any of those things. This sounds almost absurdly simple when stated this clearly, and yet most people, when they are excited and enthusiastic about an opportunity, spend almost all of their mental energy on the positive case, and essentially, no time rigorously and honestly analyzing all the ways things could go wrong. Munger made a profound habit of doing exactly the opposite, and this discipline, more than almost anything else, saved him from the kind of catastrophic mistakes that derail so many investors' careers. Connected very directly to the idea of inversion is a concept that Munger described as avoiding stupidity rather than seeking brilliance. He argued that you do not need to be exceptionally clever or unusually gifted to be a great investor. You do not need to discover things that nobody else knows. You do not need to make heroic calls about the future of technology or the direction of the economy or the political environment. What you need to do, above all else, is consistently avoid doing stupid things. And it turns out that there are a relatively small number of truly stupid things that investors do again and again, cycle after cycle, decade after decade. Things like paying far too much for a business, even if it is a great one, investing in businesses with fundamentally terrible economics because the stock price looks cheap, trusting management teams that have already shown themselves to be untrustworthy, borrowing too much money to make investments, and therefore being vulnerable to being wiped out by a temporary market decline, or selling great businesses too early simply because the stock price has gone up significantly, and it feels like a good time to take profits. Munger identified these recurring categories of investment mistakes and worked systematically to build a process that would prevent him from making them. He kept something like a mental checklist of the most common and most costly investment errors, and before making any major decision, he would go through that checklist carefully and honestly to make sure he was not committing any of those errors. This systematic, almost clinical approach to avoiding the known failure modes of investing gave him a huge and sustained advantage over investors who relied purely on intuition, enthusiasm, or the latest trend to guide their decisions. But avoiding mistakes, as important as it is only part of the story. Munger was also deeply and seriously focused on identifying and investing in businesses of truly exceptional quality. And to understand what he meant by quality, we need to discuss one of the most important and most frequently discussed concepts in the entire Munger and Buffett framework, the concept of the economic moat, or what they sometimes also described as a durable competitive advantage. A business with a durable competitive advantage is a business that has some structural feature or combination of features that protect it from competition over a very long period of time. It is a business that, even if you threw enormous resources at trying to compete with it, you would find extremely difficult to displace. The moat could come from many different sources, and understanding all of these sources is important for recognizing them when you see them. It could come from a powerful brand that consumers trust deeply and feel genuinely loyal to. a brand that represents something more than just a product, that represents an identity or a feeling or a set of values that customers want to be associated with. It could come from a network effect, where the business becomes more valuable to each individual user as the total number of users grows, so that the network itself becomes a barrier that no competitor can easily overcome. It could come from switching costs, where customers have become so deeply integrated with the company's products or services that moving to a competitor would require enormous time, effort, money, and disruption, making the rational choice simply to stay. It could come from cost advantages that allow the business to produce goods or services at a fundamentally lower cost than any competitor, meaning they can always undercut on price if they need to, while still earning a healthy return. Or it could come from regulatory or licensing advantages that make it very difficult or even impossible for new players to enter the market. The key insight that Munger emphasized was that a business with a wide and genuinely durable moat can maintain high returns on capital for a very long period of time. And in investing, as he understood with great mathematical clarity, it is not just the return you earn in the first year or two that matters. What matters most is the return you compound over many years and many decades. A business that earns extremely high returns on capital, year after year, for decades, becomes extraordinarily valuable over time. And the investor who recognizes this early and holds on through all the short-term noise can build wealth that seems almost magical to outside observers who do not understand the underlying mathematics of compounding. This compounding machine is exactly what Munger sought throughout his career. He talked about the idea of finding a wonderful business at a fair price rather than a fair business at a wonderful price. This insight represented a significant and important evolution from the pure Benjamin Graham value investing approach that Buffett had originally learned and been deeply influenced by. Graham's approach focused on buying cheap stocks, stocks that were trading well below their intrinsic value as calculated from the current balance sheet and current earnings. This approach worked well enough, but it required constant turnover. You would identify a cheap stock, buy it, wait for the price to recover to something closer to fair value, sell it, pay your taxes, and then go find the next cheap stock. It was genuinely hard work. It was highly dependent on market conditions, and it also meant that you were often investing in mediocre or merely average businesses that happened to be temporarily cheap due to some short-term problem or market overreaction. Munger pushed Buffett steadily and persistently toward a better approach, and the evolution of Berkshire Hathaway's investment philosophy over the decades reflects Munger's influence very clearly. Munger argued that the ideal investment was a wonderful business, one with a wide and durable moat that protected it from competition, run by honest and genuinely capable management who treated shareholders fairly and thought like long-term owners, bought at a fair or reasonable price, not necessarily a cheap price, and then held for a very long time, ideally forever. The magic of this approach is that you let the compounding of the underlying business do the heavy lifting for you. If the business is truly great, its intrinsic value grows year after year, driven by the high returns on capital it earns and reinvests. You do not need to sell and find a new idea every year. You do not need to trade constantly. You can simply hold and let the business compound your wealth, and the longer you hold, the more powerful the compounding becomes. This approach requires above all things a quality called patience, and patience is one of the virtues that Munger emphasized above almost all others when it came to investing. He said repeatedly, and with great conviction, that the big money in investing is made not by buying and selling frequently, not by being the most active and the most engaged, but by waiting. He described the ideal investor as someone who can sit patiently and do nothing for long periods of time, resisting every urge to act, and then can act decisively and with confidence when a truly great opportunity finally presents itself. This ability to sit still, to resist the urge to constantly be doing something, is far rarer than you might think. And it is one of the primary reasons that most investors, even very smart and very hard-working ones, tend to underperform over the long run. The stock market is a place that punishes hyperactivity. Every time you buy or sell a stock, you pay transaction costs, which directly reduce your returns. More importantly, every transaction is an opportunity to make a mistake, and the more decisions you make, the more chances there are for errors to accumulate. Munger understood deeply that concentration and patience were more powerful wealth-building tools than diversification and activity. He was completely comfortable holding a small number of great businesses for very long periods of time, and he was equally comfortable sitting with a large amount of cash and doing absolutely nothing until a truly compelling opportunity came along, even if that meant waiting for months or years. This patience was not passive or lazy in any sense. It was backed by continuous, intense, and wide-ranging learning. Munger famously spent enormous amounts of his time absorbing information and ideas, not just about business and investing, but about science, history, psychology, mathematics, biology, philosophy, and many other fields. He once described his daily routine as simply sitting in his office and absorbing. He believed that every hour spent building your mental models and deepening your genuine understanding of the world was an investment that would pay off enormously over time, even if the returns were not immediately visible. He often said that going to bed a little wiser than when you woke up was a perfectly worthy goal for every single day of your life, and that if you maintained that goal consistently for decades, the cumulative effect on your judgment and your understanding would be profound. This commitment to continuous learning across many disciplines is what led to the development of his famous approach to understanding and counteracting psychological biases and errors in judgment. Munger spent decades studying the psychology of human misjudgment, and he eventually gave a famous extended talk on this subject that has since been widely recognized as one of the most important, most original, and most practically useful pieces of thinking about investor psychology and decision-making psychology ever produced by a non-academic. He identified more than 20 separate psychological tendencies that cause people to make poor decisions in investing and in life, and he argued that understanding these tendencies deeply and actively working to counteract them was absolutely essential for anyone who wanted to make consistently good judgments in the real world. Let us go through the most important of these psychological tendencies carefully, because they are as relevant today as they were when Munger first systematized them, and because truly recognizing them in your own thinking is the necessary first step to overcoming their often devastating effects on decision-making. The first that Munger identified is the reward and punishment super-response tendency, which is the tendency for people and organizations to behave in whatever ways are rewarded, even when those behaviors are harmful in the longer run, and to avoid behaviors that are punished, even when those behaviors would be beneficial. Munger said that incentives are one of the most powerful forces in the entire universe, and he meant that almost literally. He often paraphrased a line attributed to Benjamin Franklin, saying that if you want to understand why people or organizations behave the way they do, you need to understand what they are being rewarded for and what they are being punished for. If you understand the incentive structure, you will understand the behavior. If you are confused by someone's behavior, look at the incentives, and the confusion will almost certainly resolve itself. This seems obvious when stated clearly, but investors fail to apply it with remarkable regularity. They listen to what management says they are trying to do, rather than looking carefully at what the incentive structure predicts they will actually do. Munger always looked at the incentives first. Closely related is the liking and loving tendency. People have a strong tendency to believe, support, and agree with those they like, and to ignore, minimize, or explain away evidence that contradicts a positive view of someone they admire or care about. In investing, this can lead to a very common and very costly mistake that might be described as holding a position because you love the company or the founder, even when the business fundamentals are clearly deteriorating and the thesis for owning it has genuinely changed. Munger was extremely disciplined about separating his personal feelings about a management team or a company from his objective, evidence-based assessment of the underlying business economics. He admired and genuinely liked many business leaders, but his admiration never became a substitute for rigorous analysis. Then, there is the disliking and hating tendency, which is the exact mirror image of the liking tendency. Just as people favor those they like, they tend to ignore, distort, or reflexively disagree with the views of those they dislike, or those who represent groups they are prejudiced against. An investor who has a strong negative personal feeling about a company's founder or about the industry that company operates in might miss a genuinely great investment simply because they cannot get past their initial dislike. Munger worked constantly and deliberately to separate personal feelings from business judgments, recognizing that both liking and disliking were equally dangerous distorters of clear thinking. One of the most dangerous tendencies Munger identified is the doubt avoidance tendency. The human mind, shaped by evolution over millions of years, is built to resolve doubt and uncertainty quickly, because in our evolutionary environment, uncertainty was dangerous and slow decision-making could literally get you killed. But in investing, and in many other domains of modern life, rushing to resolve uncertainty is often extremely costly. Great opportunities often look uncertain and uncomfortable from the outside, and the investors who can sit with that uncertainty, who can tolerate not knowing, who can do the careful and sometimes slow work required to properly analyze and then correctly resolve the uncertainty, tend to do dramatically better than those who jump to quick conclusions simply to relieve the psychological discomfort of not knowing. Related very closely to doubt avoidance is the inconsistency avoidance tendency. Once people form a belief or commit to a decision, they tend powerfully to resist changing it, even when substantial new evidence comes along that clearly warrants a change in view. This is sometimes called being married to a position. In investing, you buy a stock, you develop a thesis, you tell people about it, you defend it publicly, and then when evidence accumulates that the thesis was wrong, instead of selling the position and accepting the loss, you hold on and work ever harder to find new reasons to justify your original decision. This inconsistency avoidance tendency is compounded by the social dimension. The fact that admitting you were wrong can feel deeply uncomfortable when you have publicly committed to a view. Munger said clearly and repeatedly that it is extraordinarily important, even in the face of these psychological pressures, to be willing to change your mind when you get new information that genuinely warrants a change. He was not willing to be stubborn about his views when the facts clearly changed. Social proof tendency is another force of enormous power in markets and in life. People have a deep tendency to believe what those around them believe and to do what those around them are doing, taking this as evidence that the belief or behavior must be correct because so many others have adopted it. In bull markets, social proof causes investors to buy stocks at extremely high prices because everyone around them seems to be doing it and making money. In bear markets, social proof causes investors to sell at extremely low prices because everyone around them seems to be panicking and fleeing. The great investors like Munger have the psychological independence to go against the crowd when their own analysis tells them clearly that the crowd is wrong. This is one of the most genuinely difficult things to do in practice, because the social pressure to conform, to not be the outlier, to not be the one who looks foolish if the crowd turns out to be right, is extremely powerful and very difficult to resist. Authority misinfluence is yet another tendency. People follow the views of authority figures, experts, and widely recognized names, even when those figures are wrong or have clear conflicts of interest. In investing, this leads to blindly following the recommendations of famous investors, respected analysts, prominent financial commentators, or well-known economists without doing the work of independently evaluating whether their reasoning is actually sound. Munger was deeply and consistently skeptical of authority. He would listen carefully to what anyone had to say, whether famous or obscure, but he would evaluate the argument strictly on its own merits, not on the reputation or credentials of the person making it. If the reasoning was sound, it did not matter if the person was famous. If the reasoning was poor, it did not matter if the person was very famous indeed. Contrast misreaction is a subtler but important tendency. People tend to judge things not in absolute terms, but in comparison to whatever they were most recently exposed to. A price that seems cheap, compared to an even higher price that was just quoted, might still be expensive on an absolute basis when evaluated against the underlying value. An investment that seems wonderful, compared to the genuinely terrible options that were available last month, might only be mediocre when evaluated independently of that comparison. A salary that seems generous, compared to what you were earning before, might still be below what you are worth in the broader market. Munger trained himself carefully to evaluate things on their own merits in absolute terms, rather than allowing recent comparisons to distort his judgment. Stress and fear create their own category of misjudgment. Under conditions of genuine stress and intense fear, people make decisions both very quickly and very poorly. The decisions that feel most urgent and most necessary are often precisely the ones that should be made most slowly, most carefully, and with the most rigorous attention to the full range of relevant information. Market crashes are the perfect illustration. The moment of maximum market fear, when stocks are falling fast, when the news is full of doom, when respected voices are predicting disaster, is precisely the moment when most investors are in the worst possible psychological state to make good investment decisions. And yet, it is often the moment when the best investment decisions of a decade or more are sitting right in front of anyone who has the psychological strength to take them. Munger talked at length about the ability to sit on your hands during these moments of market panic, to not react, to not sell simply because everyone else is selling and it feels like the only sensible response to an emergency. He said that the ability to do nothing, to tolerate fear and uncertainty without acting impulsively to relieve the discomfort, is one of the most valuable and most rare psychological skills any investor can develop. He had this ability in an extraordinary measure, and it served him enormously well through the various crashes, corrections, and periods of deep market stress that occurred over his career. He did not just tolerate these periods. He welcomed them, because he understood that fear creates opportunity for those who are prepared, patient, and psychologically strong enough to act rationally when others cannot. The reciprocation tendency is another important force to understand. People feel a powerful obligation to return favors, to be loyal to those who have been loyal to them, to continue doing business with people and organizations they have long relationships with, even when those people or organizations are no longer the best option. In business, this tendency causes companies to continue working with advisors, suppliers, and partners who are no longer the best available option, simply because the history is long and it feels uncomfortable and ungrateful to change. Munger was vigilant about this tendency and made sure that important business decisions were always based on current merit, not on historical loyalty, however understandable that loyalty might feel emotionally. The cumulative effect of all these psychological tendencies, working together and reinforcing each other, is what Munger called the Lollapalooza effect, a term he coined to describe the situation when multiple psychological forces all point in the same direction simultaneously. He argued that in these situations, the combined effect is not just additive, but multiplicative, creating a cascade of irrational behavior that sweeps up almost everyone who is not specifically watching for it and actively and systematically working to resist it. The financial crisis of 2008 is perhaps the clearest example in recent history of a Lollapalooza effect in action. Incentive structures throughout the financial system that rewarded short-term risk-taking at the expense of long-term soundness. Social proof that made everyone feel comfortable because everyone else was doing the same thing, and all the smart people seemed fine with it. Authority figures, ranging from senior bank executives to government regulators to leading economists who assured the world that the risks were manageable and well understood. Optimism bias that caused both professionals and ordinary homebuyers to discount negative scenarios as unlikely. Reciprocation tendencies that kept business relationships going even when they should have been terminated. All of these powerful psychological forces combine to create a catastrophic failure of judgment across an entire industry and an entire financial system, the consequences of which were felt by hundreds of millions of people around the world. Munger said that the best, and indeed the only real defense against Lollapalooza effects, is to understand them at a deep level, to build systematic checks into your decision-making process that force you to consider perspectives you might not naturally reach on your own, and to cultivate a degree of psychological independence that allows you to say clearly and firmly, no, when everyone around you is saying yes. This is not at all easy. It requires years of deliberate practice, deep self-examination, and the kind of intellectual courage that not everyone possesses naturally, though it can be developed over time. But it is genuinely one of the most valuable things any serious investor can build in themselves. Now let us turn to another critical and central dimension of Munger's thinking, his views on the fundamental nature of businesses and what makes one business genuinely better than another as a long-term investment. This is perhaps the practical heart of his investment philosophy. Munger developed a very clear and very useful view of the difference between what he called a great business and an ordinary or mediocre business. An ordinary business is one that earns average or below average returns on the capital it employs, that must constantly reinvest large amounts of that capital just to maintain its existing competitive position, and that faces relentless and effective pressure from competitors who are always trying to take its customers and erode its profits. Running an ordinary business requires enormous and continuous amounts of hard work, creativity, management skill, and capital just to stay roughly in place. The owners of such businesses can earn a reasonable living and perhaps a reasonable return on their investment, but the process is difficult, uncertain, and exhausting. A great business is something categorically different. A great business is one that can deploy capital at very high rates of return consistently, year after year, over long periods. It is one where the competitive moat is so wide and so genuinely durable that the business can raise its prices periodically without losing customers to competitors, that can expand into adjacent markets with relatively modest amounts of capital investment, and that generates large and growing amounts of free cash flow that can either be reinvested in the business at those same high rates of return or returned to shareholders in the form of dividends or share repurchases. A great business, held for a long enough period of time and bought at a reasonable price, compounds wealth at rates that can seem almost impossible to those who have not experienced or studied them carefully. Munger gave the example of See's Candies, a California-based chocolate company that Berkshire Hathaway bought in 1972 for $25 million. At the time of purchase, the business earned approximately $4 million in pre-tax profit per year. The price paid was already a significant premium to the book value of the assets, which would have made Benjamin Graham deeply uncomfortable, and which a purely value-focused investor of the old school would likely have rejected. But Munger and Buffett recognized that See's had something that did not show up on the balance sheet, but was enormously valuable: a powerful, well-established brand, and a deeply loyal customer base in California, people who associated See's chocolates with celebrations, with gifts, with love, with important moments in their lives. This emotional connection translated into pricing power, which was the single most important characteristic Munger looked for in any business. Over the subsequent decades, See's generated hundreds of millions of dollars in cumulative pre-tax earnings, and virtually all of that was free cash flow that Berkshire could deploy in other investments. The reason the cash flow was so high relative to the business's needs was that See's did not require large amounts of ongoing capital reinvestment to maintain its competitive position. It did not need to build new factories every year or acquire new assets to stay competitive. The competitive advantage was in the brand, in the customer loyalty, in the reputation, and these things required relatively little capital to maintain once they had been established. This combination of high returns on capital and low capital requirements is the definition of a great business in Munger's framework, and See's was a near-perfect example of it. On the other side of the spectrum, Munger talked at length about what he described as the terrible economics of commodity businesses, businesses where the product or service being sold is essentially identical to what competitors offer, where customers make their purchasing decisions almost entirely on the basis of price, and where no individual company has any lasting competitive advantage over the others. In commodity businesses, the relentless pressure of competition keeps returns on capital persistently low, often at or below the cost of capital. Anytime one company in a commodity industry invests to lower its costs, competitors are forced to match that investment, and the resulting cost savings are eventually competed away in the form of lower prices for customers, with no permanent benefit to any of the companies involved. The airline industry is the example that Munger and Buffett return to most frequently when discussing commodity businesses. Despite the fact that air travel grew dramatically over the second half of the 20th century and into the 21st, the airline industry as a whole destroyed enormous amounts of capital during this period, and shareholders across the industry earned, on average, very poor returns over long periods of time. The reason was that airlines all essentially offered the same product, flying people from one place to another, and customers' primary decision criterion was almost always price. This meant that no airline ever developed a sustainable competitive advantage, and the economics of the industry remained persistently poor despite all the investment and effort that went into it. Munger and Buffett recognized this pattern early and largely avoided the airline industry for most of their careers, understanding that no matter how good the management or how efficient the operations, you simply could not earn great long-term returns in a business where the fundamental economics were stacked against you. This is a critical lesson for any investor. You can have the best management in the world, the most efficient operations, the most dedicated employees, but if the fundamental business economics are poor because the competitive moat does not exist, you will struggle to earn good returns over time. The key lesson is that the quality of the business you invest in matters enormously, perhaps more than any other single factor, and perhaps more than most investors appreciate. A mediocre business bought at a cheap price is usually still a mediocre investment, because the mediocre returns of the underlying business set a ceiling on what you can earn, and paying even a cheap price does not change those underlying returns. A great business bought at a fair price is usually a great investment, because the high returns of the underlying business compound powerfully over time, and even a fair price, not a bargain price, leaves you participating in that compounding from the beginning. This sounds simple, and yet most investors, influenced by the powerful idea that cheap stocks are better than expensive ones, spend the majority of their time and energy trying to find cheap stocks rather than trying to find genuinely great businesses. Munger argued that the allocation of effort should be heavily weighted toward understanding what makes a business great, and then being patient enough to wait for an opportunity to buy such a business at a price that makes sense. How do you identify a great business? Munger had several clear and practical criteria that he applied consistently. First, and most importantly, look for businesses with strong and durable pricing power. A business that can raise its prices year after year, or even periodically, without losing a meaningful number of customers to competitors, is a business with a genuine and powerful competitive advantage. The classic test Munger described was to ask what would happen if this business raised its prices by 10% tomorrow. If the honest answer is that it would lose very few customers, because those customers genuinely value what the business offers and have no compelling alternative they would prefer, then the business has real pricing power and a real competitive advantage. If the honest answer is that it would lose a large proportion of its customers immediately to cheaper competitors, then the business is essentially a commodity business with no meaningful competitive advantage. Second, look for businesses that generate high returns on invested capital, consistently over time, and not just in unusually favorable conditions. Returns on invested capital measure how much profit a business generates for each dollar it has deployed in the business. High returns on invested capital mean that the business can grow without needing large amounts of new capital, and they mean that the existing capital in the business is being put to work very productively. Businesses with high and sustained returns on invested capital are the ones that compound wealth most efficiently over time, and identifying them early and correctly is one of the most valuable things any investor can do. Third, look for businesses with simple, clear, and understandable economics. Munger was always deeply committed to the concept of the circle of competence, which we will discuss in detail shortly. And one of the things he looked for in any potential investment was whether the business's economics were clear enough and simple enough that he could understand them deeply and evaluate them confidently. He was not interested in complex financial structures or in businesses whose success depended on predicting technological developments that were inherently uncertain. He wanted businesses where the fundamental economics were transparent, where the source of competitive advantage was identifiable and understandable, and where the long-term prospects could be evaluated with a reasonable degree of confidence based on careful analysis. Fourth, look for management teams that are honest, genuinely capable, and truly shareholder-friendly in their behavior, and not just in their words. Munger placed enormous importance on the quality and the integrity of the people running any business he considered investing in. He often said that you want to be in business with people who are not just smart and hardworking, but who are genuinely honest, who treat shareholders the way they themselves would want to be treated if they were the shareholders. He was deeply skeptical of management teams that paid themselves in ways that were not aligned with the actual value they created for shareholders, that made acquisitions primarily to grow their own empires and compensation packages rather than to genuinely create value, or that communicated with shareholders in a way that was more promotional and optimistic than it was honest and realistic. He talked extensively about the importance of what he called owner-operators, people who have significant personal financial stakes in the businesses they run, and who therefore think like owners rather than like hired employees who are optimizing for their salaries and their bonuses. When the financial interests of management are genuinely aligned with the financial interests of shareholders, the probability of good outcomes for investors is dramatically higher. When there is a meaningful misalignment, when managers can profit from behaviors that are actually harmful to shareholders, investors tend to get hurt. Munger and Buffett were famously direct about avoiding businesses where they had any serious doubt about management integrity, even when the underlying economics of the business looked attractive on paper. They argued that a great business run by dishonest or self-serving management is not a great investment because dishonest management will eventually, and sometimes quite cleverly, find ways to enrich themselves at shareholders' expense. They said they would rather own a mediocre business run by exceptional, honest, shareholder-friendly management than a great business run by management of questionable integrity. Now, let us turn to one of the most important and most frequently discussed concepts in all of Munger's teaching, the concept of the circle of competence. This idea is crucial for understanding how Munger approached investing decisions, and it is also deeply relevant and directly applicable for anyone making important decisions in any field or any area of life. Your circle of competence is the domain of knowledge, experience, and genuine understanding within which you can make reliable, well-founded judgments. It is the specific area where you have genuine, deep, tested understanding based on years of study and experience, where your pattern recognition has been developed and calibrated by real-world feedback, and where your assessments of value, risk, and likely outcomes are genuinely grounded in something solid rather than in hope or guesswork. Outside your circle of competence, you are at the mercy of your biases and your incomplete understanding. You may feel just as confident as you would feel inside your circle of competence, which is itself one of the most dangerous aspects of going outside it, because the confidence is not backed by real knowledge. It is an illusion. And in investing, misplaced confidence, the kind that feels genuine but is not backed by genuine understanding, is one of the most dangerous and most expensive states you can be in. Munger argued clearly and forcefully that the key to successful investing is not to try to be competent across every area of business, not to have an opinion about every sector and every company, but to know your circle of competence very well, to stay strictly within it when making important decisions, and to work continuously over time to expand it. When an attractive-looking opportunity presents itself outside your circle of competence, the right response is almost always to pass on it, no matter how exciting it looks from the outside. Because if you do not truly understand the business, you cannot evaluate the real risks with any accuracy. You are likely to either overpay or to miss important dangers that would be obvious to someone who did understand the business deeply. This is a principle that most investors find genuinely difficult to follow in practice. There is enormous psychological and social pressure to have views about everything, to seem knowledgeable across all sectors and all markets. The financial industry and the financial media are specifically designed to make investors feel that they need to have a view on everything and that they should be constantly trading and adjusting and responding to every development. Munger pushed back against this pressure consistently and forcefully throughout his career. He said that passing on an opportunity you do not understand is not a weakness and not a failure. It is a sign of wisdom, and it protects you from the most dangerous category of investment mistake, which is the mistake made not from stupidity, but from misplaced confidence. He gave the very famous and often cited example of technology businesses, particularly during the rise of the Internet in the 1990s. He and Buffett famously and conspicuously passed on investing in most technology companies during that period, not because they thought technology was a bad business or because they were technologically illiterate, but because they genuinely could not evaluate the long-term competitive dynamics of most technology businesses with sufficient confidence to make reliable judgments about intrinsic value. They knew they did not know, and that knowledge of their own ignorance, honest and clear-eyed as it was, turned out to be far more valuable than the false confidence that would have led them to invest in things they did not truly understand, as so many other investors did during the dot-com bubble of the late 1990s. Meanwhile, they focused relentlessly and profitably on businesses they could understand deeply, businesses like insurance, which has clear economics and a long, well-documented history that allows careful students to understand the key variables. Businesses like consumer brand companies, where the competitive dynamics are relatively stable and the sources of competitive advantage are identifiable. Businesses like simple financial services, companies, and utilities, and infrastructure assets. In these areas, Munger and Buffett had genuine expertise built over decades of experience and study, and they could make reliable and confident assessments of value and risk that gave them real, sustainable advantages over investors who were spreading their attention across dozens of different sectors without genuine depth in any of them. The circle of competence concept also connects to Munger's broader and deeply considered philosophy about the relationship between breadth of knowledge and depth of expertise. He was himself one of the most extraordinarily broad learners of his era, someone who had genuine, serious knowledge across an unusually wide range of disciplines, and who could discuss biology and physics and history and psychology and mathematics and economics all with equal facility. But he was absolutely clear that breadth of knowledge should support and deepen your core areas of competence, not replace them. The mental models you borrow from other disciplines should be tools that help you see your area of genuine expertise more clearly, more completely, and from more angles, not excuses to wander into areas where you have no real edge and where your feeling of competence is not backed by real understanding. Now let us spend time on the subject of the power of compounding, because this concept sits at the very heart of Munger's investment philosophy and of his entire approach to building wealth, knowledge, and capability over time. Munger had a deep, almost reverential appreciation for the mathematics of compounding that went far beyond an academic understanding. He truly felt its power at a visceral level, and this feeling shaped every important decision he made. He understood, with remarkable clarity, that small differences in the rate of return, sustained over long periods of time, produce enormous and almost incomprehensible differences in final wealth. Consider the difference between earning 8% per year and earning 12% per year. Year by year, those extra 4 percentage points do not seem like a very big deal. But sustained over 40 years, the difference between these two rates of return is not just double or triple, it is more than 10 times. The same initial investment that grows to a certain amount at 8% per year would grow to more than 10 times that amount at 12% per year over the same 40-year period. Understanding this mathematics at a gut level, not just as an abstract calculation, but as something you actually feel and internalize, changes the way you think about every important investment decision. It meant that Munger was willing to pay a fair price for a truly wonderful business, even when the initial yield on the investment looked modest, because he knew that if the business could sustain genuinely high returns on capital for decades, the compounding of those returns would produce extraordinary wealth that vastly exceeded whatever premium had been paid at the beginning. It meant he was deeply reluctant to sell his best businesses, even when the short-term stock price looked full or even extended, because selling meant interrupting the compounding at precisely the moment when it was working hardest for him, and also meant paying taxes on the accumulated gains, which further reduced the long-term return. And it meant he was deeply and consistently skeptical of any investment approach that tried to optimize for short-term returns at the cost of sacrificing long-term compounding, because the mathematics of long-term compounding are so powerful that almost no short-term gain is worth sacrificing them. He often described the ideal investment approach as finding the best businesses in the world, buying them at reasonable prices, and then simply not selling them, leaving the compounding undisturbed for as long as possible. He described this as the most powerful wealth-building strategy available to any investor who had the patience and the discipline to actually follow it, which, as he noted with characteristic dry humor, was far fewer people than claimed to understand it. Of course, the flip side of the power of compounding working for you as an investor is the devastating and often underappreciated power of compounding working against you when you are on the wrong side of it. Debt is the most obvious and most dangerous example. Interest compounds against you as a borrower, just as investment returns compound for you as an investor. A manageable amount of debt at a high interest rate, sustained over a long period without being paid down, can grow into an enormous and suffocating burden. Munger was deeply, almost viscerally conservative about the use of leverage in personal finance, in business finance, and especially in investment finance. He genuinely hated debt and what it did to the psychology and the options of those who carried too much of it. He talked about the critical importance of surviving bad times intact, with your financial position unimpaired and your ability to act unimpaired. Every investor, over a career long enough to be meaningful, will experience periods of extreme market stress, periods when stock prices fall dramatically and quickly, when the economic environment deteriorates, when businesses that seemed solid and well-positioned turn out to have hidden weaknesses that the crisis exposes. The investors who survive these periods with their capital base intact, who do not have to sell their investments at distressed prices because they carried too much leverage or because they needed the cash for other obligations, are the ones who can take full advantage of the extraordinary buying opportunities that these periods of stress always create. Staying financially resilient, maintaining the ability to act rather than being forced to react during periods of market stress is one of the most important structural advantages any long-term investor can engineer into their financial life. Munger also talked thoughtfully about the importance of minimizing unnecessary taxes, not through aggressive tax avoidance schemes, but through the simple and legal strategy of holding great businesses for very long periods and therefore deferring capital gains taxes far into the future. As long as you hold an appreciated investment, the tax on the unrealized gain is deferred. Only when you sell do you actually have to pay the tax. And because deferred taxes function economically very similarly to an interest-free loan from the government, the ability to defer capital gains by holding great businesses rather than constantly selling and reinvesting is a significant and often underappreciated source of long-term return advantage for patient, long-term investors. This is another important reason why Munger and Buffett so strongly preferred to buy great businesses and hold them for very long periods. They were not just being patient for its own sake. They were recognizing that the tax advantages of long-term holding, combined with the compounding of underlying business value, created total returns that were dramatically superior to those achievable through more active trading strategies, even if those active strategies had somewhat higher pre-tax returns in the short run. Let us now discuss Munger's views on the role of character, ethics, and integrity in investing and in business more broadly, because this dimension of his thinking is sometimes underemphasized in discussions of his investment philosophy, and yet Munger himself considered it absolutely fundamental to everything he believed and practiced. Munger was not someone who treated ethics as a constraint on wealth creation, as a box you had to check because of external pressure from regulators or the public. He genuinely believed, with deep conviction and with the support of decades of observed evidence, that ethical behavior was essential for long-term success in business and in life. He argued that a reputation for genuine integrity and honesty was one of the most valuable assets any business or individual could possess. He recognized that this reputation took decades to build through consistent behavior across thousands of small decisions and could be destroyed in a very short time through a single serious lapse in judgment or a single dishonest act. He was deeply critical, and not at all shy about expressing that criticism publicly, of business practices that he considered short-sighted or damaging to long-term trust, even when those practices were technically within the bounds of the law. He criticized the practice of paying executives amounts of money that bore no credible relationship to the value they had actually created for shareholders, noting that the processes by which executive compensation was set were often captured by the very people whose compensation was being determined. He criticized accounting practices that technically complied with the rules, but gave investors a misleading or overly optimistic picture of the underlying economics of the business. He criticized acquisition strategies driven primarily by the desire to grow executive empires and maximize management compensation, rather than to genuinely create value for the shareholders who had entrusted their capital to these management teams. He enormously admired businesses and business leaders who communicated with genuine candor, who shared bad news as readily and as promptly as good news, who set expectations that were realistic rather than promotional, who made capital allocation decisions based on long-term value creation rather than on the short-term effect on the stock price, and who treated every stakeholder, employees, customers, suppliers, communities, and shareholders with genuine respect and fairness. And he argued consistently that these behaviors were not just morally admirable in themselves, but were also strategically very smart, because they built the kind of deep trust and genuine loyalty that provided real and durable competitive advantages over those who pursued short-term interests at the expense of long-term relationships. He talked about the importance of seeking out and staying in business environments and business relationships where the ethical questions never arose as close calls. He said that if you found yourself in situations where you were constantly having to think hard about whether something was technically permissible or technically legal, you were probably in the wrong environment entirely. The ideal was to be in businesses and to associate with people where integrity was so deeply embedded in the culture and in the character of the individuals that ethical questions simply never required active deliberation because the right answer was always the obvious answer. He talked about the importance of character in management teams from a very practical investor's perspective. He said that one of the most reliable indicators of whether a management team was truly trustworthy was their behavior in situations where they could have acted dishonestly or selfishly without detection. The people who maintained their integrity not because they were afraid of being caught and punished, but because honest dealing was genuinely who they were and how they chose to conduct themselves. Those were the people worth trusting with your capital. And finding people like that, and then sticking with them through the inevitable difficulties that every business faces, was one of the most valuable things a long-term investor could do. He told stories of cases where he or Buffett had found businesses that looked financially attractive on the numbers, but where something about the management team or the business practices made them feel uncomfortable in ways that were difficult to articulate precisely. In almost every case where they had gone ahead with an investment, despite that discomfort, the outcome had been poor. And in many cases where they had deliberately walked away from financially attractive opportunities because of concerns about integrity, they had later discovered that their concerns were entirely well-founded. He drew a clear, simple, and powerful lesson from these repeated experiences. When in doubt about the ethics of a business or a management team, do not invest. The financial opportunity is simply never worth the risk of partnering with people who do not share your values. Let us now discuss one of the most practically useful of all Munger's concepts, his analysis of what he called the man with a hammer syndrome. The great insight embedded in this idea is that every person, as a result of their education, their professional experience, and their cognitive habits, tends to reach for the same tool or the same framework when confronted with any problem. If you are trained as an economist, you will naturally analyze situations through an economic lens. If you are trained as a psychologist, you will naturally look for psychological explanations. If you are a financial analyst, you will naturally evaluate every situation through the lens of financial ratios and valuation models. And while these lenses can be genuinely useful within their proper domains, they can lead you badly astray when you apply them as if they were the only tool you needed, ignoring all the other dimensions of a situation that fall outside your single discipline's framework. The solution, as Munger saw it clearly, was to build and maintain a genuinely broad toolkit of mental models drawn from many different disciplines, and to approach every significant situation by deliberately asking which of these models are most relevant here, which ones illuminate aspects of the situation that the others miss, and how do these different perspectives combine to give a more complete picture than any single discipline could provide. This kind of deliberate, multidisciplinary thinking was central to everything that distinguished Munger from most other investors and thinkers. He spent decades consciously building this toolkit. He would identify the key ideas in a new field he wanted to understand, absorb them with genuine depth and seriousness, and integrate them into his existing mental framework. Then, when he encountered a new investment opportunity or a new business problem, he would run through his mental inventory and ask which of his models applied most directly to this particular situation, which ones generated the most useful insights, and which ones suggested risks or opportunities that a single discipline analysis would likely miss. This systematic, almost scientific approach to applying diverse mental models gave him a consistent edge over investors who were far narrower in their thinking, no matter how deeply they knew their particular specialty. Let us now bring our exploration of these extraordinary ideas toward its final chapters, because we have now covered the most important of the foundational concepts, and it is time to weave them together into a coherent picture of how they all work together in practice. The genius of Munger's approach, the thing that makes it not just intellectually interesting, but practically powerful, is the way all these different elements reinforce each other. The mental models provide the framework for clear thinking. The psychological bias awareness prevents clear thinking from being derailed by cognitive traps. The circle of competence discipline ensures that the clear thinking is applied only where it is genuinely reliable. The inversion principle ensures that both the positive and the negative possibilities are always fully considered. The focus on great businesses with durable competitive advantages ensures that you are putting your well-thought-through capital in places where the underlying economics will compound it powerfully over time. And the patience and the long-term perspective ensures that you give the compounding enough time to work its magic. These elements do not just add together, they multiply together. A clear thinker who is also psychologically self-aware is dramatically more powerful than just a clear thinker. A clear, psychologically self-aware thinker who also stays within their circle of competence is more powerful still. And a clear, psychologically self-aware, competence-disciplined thinker who also focuses on great businesses and holds them patiently for long periods is the kind of investor who produces the extraordinary results that Charlie Munger produced over his extraordinary career. Now let us think about what all of this means for you, the investor who is engaging with these ideas right now in the context of your own investment decisions and your own financial life. What are the most important and most immediately actionable takeaways from the entire body of Munger's wisdom? The first and most fundamental action you can take is to begin building your own latticework of mental models, deliberately and systematically. This means going beyond the specific domain of your current professional expertise and absorbing the most important ideas from fields you have not previously studied deeply. It means being genuinely curious about how the world works in all its dimensions, not just the dimensions that your current career requires you to understand. And it means doing this not as a box-checking exercise, but as a genuine intellectual pursuit driven by real curiosity and the honest desire to understand things better. Munger himself said many times that learning across many disciplines was one of the most enjoyable things he did, not a chore, but a genuine pleasure, and that this enjoyment was itself a sign that he was on the right path. The second important action is to develop a serious and honest understanding of your own psychological biases. This is genuinely difficult because the whole nature of psychological biases is that they feel from the inside exactly like correct judgment. The person in the grip of social proof does not feel like they are mindlessly following the crowd. They feel like they are responding rationally to important information about what everyone around them has figured out. The person in the grip of inconsistency avoidance does not feel like they are stubbornly ignoring evidence that they were wrong. They feel like they are maintaining a well-reasoned position against unfair criticism. The only way to see through these feelings is to study the biases intellectually, to understand them well enough, to recognize their signatures even when you are in the middle of experiencing them, and to build systematic checks and processes that protect your decision-making from their effects. The third important action is to define your circle of competence honestly and to practice the discipline of staying within it. This means identifying the specific industries, business types, and investment situations that you genuinely understand deeply, where your assessment of value and risk is genuinely reliable, and then committing to focus your investment activity within those areas. It also means being genuinely honest with yourself about what falls outside your circle, even when what falls outside looks very exciting. The discipline to say clearly, "This is interesting, but I do not understand it well enough to invest in it reliably," is one of the most protective disciplines any investor can develop. And over time, you can expand your circle through deliberate study and experience, gradually widening the domain within which your judgment is genuinely reliable. The fourth important action is to practice inversion in all of your important decisions. Before you commit to any significant investment, take time to seriously and rigorously ask yourself what the ways are in which this investment could fail badly, what the risks are that you have not fully considered, what the assumptions in your thesis are that, if wrong, would make this a very poor investment, and whether there are scenarios you have been unconsciously discounting because they feel unlikely or inconvenient. The mental discipline of actively looking for the ways you might be wrong, of genuinely trying to poke holes in your own thesis before committing capital, is one of the most valuable intellectual habits any investor can develop. The fifth important action is to focus your search for investment opportunities on businesses with genuinely durable competitive advantages, and to be willing to pay fair prices for them rather than waiting indefinitely for them to become extraordinarily cheap. The businesses that meet Munger's criteria for greatness, strong pricing power, high returns on invested capital, simple and understandable economics, and excellent management, are relatively rare. But they are identifiable if you know what you are looking for and if you are willing to do the deep analytical work required. And once identified, they deserve patient, long-term ownership, not the constant trading in and out that destroys so much of the return that the underlying business would otherwise generate for you. The sixth important action is to be deeply conservative about leverage and to maintain your financial resilience at all times. Do not borrow to invest. Do not maintain a financial position so stretched that a temporary market decline or a business setback could force you to sell assets at the worst possible time. The ability to remain patient and solvent through difficult periods is enormously valuable, both because it protects you from being permanently harmed by temporary adversity and because it puts you in a position to take advantage of the opportunities that adversity creates. The seventh, and in some ways the most encompassing action, is to commit genuinely to continuous learning across your entire life. Not just learning about investing, but learning about the world in its full complexity, about human nature, about history, about science, about how different systems work and interact. Munger believed with great conviction that this kind of broad, genuine, curiosity-driven learning was the foundation of everything else, that it was what built the mental models, developed the judgment, expanded the circle of competence, and created the kind of clear, integrative thinking that allowed great decisions to be made consistently over long periods of time. Charlie Munger was, in the end, a man who built an extraordinary life through the disciplined, patient, joyful application of his intelligence to the world of business and ideas. He was not perfect. He made mistakes, as every investor does, and he was honest about them. He was not lucky in any simple sense, though he recognized the role that luck plays in every life, and was genuinely grateful for the favorable circumstances he had been born into and had encountered along the way. What he was, above all else, was a man who took ideas seriously, who took thinking seriously, who took the responsibility of being a steward of other people's capital seriously, and who brought to every significant challenge in his life the full power of a mind that he had spent decades building, sharpening, and expanding. He lived to 99 years of age and remained intellectually sharp, engaged, curious, and willing to share his wisdom right up to the very end of his life. He attended Berkshire Hathaway annual meetings in his 90s, sparring intellectually with questioners from around the world, still delighting in the process of thinking through difficult questions in real time. He gave lectures and interviews, and wrote and spoke about the ideas that had shaped his thinking with a generosity and a clarity that few people ever achieve. The legacy he left behind is not just the extraordinary financial record of Berkshire Hathaway, remarkable as that record is. It is a body of ideas about how to think, how to decide, how to learn, how to evaluate businesses, how to understand human nature and its effects on markets, and how to live a life of intellectual integrity and genuine contribution. These ideas are available to anyone who is willing to engage with them seriously and to do the work of truly understanding and applying them. The wisdom of Charlie Munger is in the deepest sense a gift to all of us who care about thinking well and deciding well and building something of genuine and lasting value. But like all truly valuable gifts, it only becomes what it can be when it is received properly. And receiving it properly means not just admiring it from a distance, but actually putting it to work, day after day, decision after decision, year after year, letting the habits of thought, It encourages compound just as surely and just as powerfully as the financial returns it is designed to help you generate. Take these ideas seriously. Absorb them deeply. Build your mental models across many disciplines. Stay honestly within your circle of competence while working steadily and genuinely to expand it. Invert your problems always, and especially when you are most excited about an opportunity. Be rigorously honest with yourself about what you know and what you do not. Find wonderful businesses with durable competitive advantages, buy them at fair prices, and hold them patiently for very long periods without disrupting the compounding. Be deeply conservative about leverage and maintain your financial resilience through all conditions. Treat every person you deal with in business and in life with genuine honesty and genuine respect. Keep learning every single day for the rest of your life, because the compound effect of getting a little wiser every day, sustained over decades, is one of the most powerful forces you will ever have access to. That is the Tao of Charlie Munger. It is not a system of tricks or shortcuts. It is not a mechanical formula that you can follow without genuine understanding. It is a way of thinking, a way of approaching the world with curiosity and honesty and rigor and patience that produces results of extraordinary quality over sufficiently long periods of time for those who genuinely understand and genuinely practice it. It worked for Charlie Munger across 9 decades of an extraordinary life. It can work for you. The compound effect of better thinking, applied consistently over time, is something genuinely remarkable, and the door to it is open to anyone willing to walk through it with the seriousness and the commitment it deserves. The greatest investment you will ever make is not in any stock or any business. It is in the quality of your own thinking. And Charlie Munger is the greatest teacher of that investment that the world has yet produced.